Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Alasdair Macleod and Peter Boockvar. Alasdair is head of research for Gold Money and an Austrian economist. He has a background as a stockbroker, banker, and fund manager. Peter is the chief market analyst with the Lindsay Group and co-chief investment officer with Bookmark Advisors. He has a new newsletter product called the Book Report, spelled BOOCKREPORT.com, one word. And that offers great macroeconomic insight and perspective with lots of updates on economics indicators. Welcome, gentlemen.
Thank you for having us on.
Great. So I thought today we'd have a discussion on geopolitics and central bank monetary policy trends and developments. And of course, the implications of those on the global economy and the financial markets, especially considering what's happening today. We're here today, Wednesday, May 17. The markets have taken a move to the downside. Discussions about impeachment regarding U.S. President Donald Trump, and lots going on geopolitically. So maybe we begin with that discussion of the Trump factor, Peter?
Yeah, so I think up to this point, up to yesterday, the noise around Trump was, in the eyes of the market, was just noise. The market was laser focused on, we want tax reform, we want healthcare reform, and let's focus on the policy, and Trump's personality and his tweets is just noise, and we're going to block it out. And I think that noise with yesterday got so loud and crossed the line that the market couldn't ignore this any longer, because they know that he needs all the credibility and all the stature in order to get the tax reform that markets have been anticipating. Because again, the market has been solely focused on tax reform and not paying attention to central banks that are pulling back and the issues with the U.S. economy and seeing mediocre growth. It's been all chips on the table of Trump's going to make things great with tax reform, and I don't care about anything else. And this is a gigantic wake-up call that the belief that everything is going to go smooth was hugely naive.
Is this a major transition point, Peter? Or do you see this or just a one-day event?
Well, it seems that this is going to be much more than a one-day event, just based on what was said, what the memo is. Now, of course, we're going to have to hear from Comey. He's going to be testifying, so there's more details to be had. There are probably more memos to be looked at. So this is just the beginning, but now you have a dark cloud over the Trump agenda. And as I said, the whole bull case was the Trump agenda. So you take that away, at the same time the Fed's raising interest rates, and the U.S. economy is mediocre at best, and the yield curve keeps flattening. Well, there was no room for error in terms of valuations, and it's that kind of cocktail that gives us a sell-off like we're having today.
And your thoughts on that, Alasdair?
Well, I was just sort of thinking, actually, as Peter was talking, that, Trump for the markets is the great white hope. Which, but no, more seriously, Trump's problem, I think, is there is a huge, great turf war raging in the White House. On the one side, you have got the established security services. On the other hand, you've got Trump and his preferred aides, assistants, his men, if you like. And this is turning out to be some fight. And the central point about this, I think, is you've got the sort of the neocon McCain type faction who are hell-bent on continuing to wage a Cold War against Russia and China. And you've got Trump, who came in as a peacenik I mean, he really was. He was even saying that he would meet the leader of North Korea and see what his gripes were and all the rest of it. And that very soon turned round. He's turned into someone who has actually started quite a few actions around the world. I mean, it started with the Yemen. We also had the bomb in Afghanistan. We've got North Korea. We've got saber rattling against Iran. We've got the missile launch against Syria. We've got troops being sent to ISIS. And the most recent thing is that there is a move to send American troops to Afghanistan to support the regime in Kabul. So, the whole thing has turned round. Now, what really interests me in all this is the other side, which we're not really looking at all, is that President Xi came over, and the feeling I got from the meeting with Trump was that they actually got on. I think President Xi, the way I read him, is he's actually got quite a lot of charisma, but he's no fool. But I think the result is that there is a dialogue now between Trump and President Xi. I think Trump still wants to do the same with Putin, but he's being prevented from doing that because there are so many leaks accusing him of leaking stuff to Russia, appointing someone who's said the wrong things to the Russians, gone beyond his brief. You've got all this turf war going on. And I think the unfortunate thing about it is that it really, over today and yesterday, it has moved away from that into the public domain. And this is now becoming an issue. They're now talking about impeachment and all the rest of it. So the noise, if you like, the fallout from the turf war is beginning to destabilize things. And I just hope that it doesn't destabilize it too much, because I feel fairly certain that Trump actually does have lines of communication with Putin and also with President Xi, which in the final analysis is going to be very good for all of us. I don't really go with the neocon idea that we've got to continue with the Cold War. That, I think, is fundamentally a mistake. And
in terms of the reaction by central banks, Peter, do you see any change in policy by the Federal Reserve as a result of this transition? Like, will there be more accommodative easing, or what will be the effects on interest rate policy?
Well, interestingly, today rate hike odds have gone down, but I think the Fed needs to. I think the Fed, at the end of the day, is still going to focus on the numbers that they see, and in their eyes, they've reached their so-called mandates, both in terms of employment and inflation, and they're going to raise interest rates. I mean, are they going to maybe not raise 2 more times, maybe do once, or stick with their balance sheet because of issues with Trump? Yeah, maybe. I mean, we're dealing with an extraordinarily dovish Fed still. And I think that'll be an interesting needle to thread in how they manage the political landscape versus what they should be doing on the economy. Because even if Trump gets impeached, Mike Pence will just carry out what Trump did. So I think the Fed should not be focused on the politics and focus more on what policies will come out if either a Trump or a Pence. And I'm not going to sit here and talk about impeachment, but you get my point that I think they're going to focus on what policies are going to come, and whether it's going to be this year or next year. But even so, the Fed seems intent on raising a few more times and shrinking their balance sheet. And I don't see a reason why that's going to change just yet.
And what do you see as the likelihood of impeachment and even like associated policies on tax reform and fiscal stimulus?
I mean, I have no idea on impeachment because the Republicans control the House. So Paul Ryan's going to have to do a 180 and turn things around to get an impeachment. So right now I'm not even going to go there until we get a lot more details. Yeah. But it certainly throws up into the air when tax reform and healthcare reform is actually going to get done. Now, the policy wonks are still working on. I mean, I guarantee you today, the policy people in Washington working on healthcare and tax reform. And they were going to do that regardless of what Comey memo showed up in the newspapers or on TV. They're going to continue to focus on policy, and as policy people do. So that will continue. But yeah, of course. I mean, everyone has to ask the question of if Trump is now losing credibility, what moral suasion is he going to have on this process to get something passed? And if we don't get something passed this year and it bleeds into next year, well, that's going to have economic implications this year, because if you're a corporate CEO or CFO, you may freeze some decision making and say, you know what, if I'm got to wait till next year to get that tax break or that tax cut, well, then I'll make the decisions next year instead of this year on capital spending or anything else. So yeah, that's what the market is basically questioning today. I mean, I don't think they can care less whether Trump is president or not. They're just worried about what happens to his agenda.
Yeah, and your thoughts, Alasdair?
Well, I agree with Peter on that. And I mean, the basic job of the Fed is to try and manage monetary policy in the context of what the economy is actually doing. And having driven interest rates down close to zero, there comes a point where the Fed should try and normalize. And as Peter points out, the inflation and unemployment statistics have now come back to target, and basically that means that interest rates should be normalized and steps should be taken in that direction. But I think the problem the Fed has is that there is so much debt in the US economy, both government sector and private sector, that to raise interest rates very much would actually destabilize the situation. And I think this is why they're really being very cautious about the rate at which they increase interest rates. It is my view that if they raised the Fed funds rate to somewhere in the region of 2.5%, they would bring on the next credit crisis, if you like, the crisis side of the credit cycle. I mean, we always end up with a crisis on every credit cycle. These aren't business cycles, these are credit cycles. And I think that the Fed is very much aware of the debt situation, and what they don't want to do is to raise rates as they did back in 2006-07 to the point where it creates a crunch. But they don't actually know where that point is. I can tell them it's around about 2 to 2.5%. So assuming that people in the Fed have got some sort of inkling on this, then I think that's as far as it's going to go, but they're not going to want to keep rates right down. I mean, remember, you've got all those excess reserves sitting on the balance sheet. You don't want them leaching out and inflating the situation so that eventually prices start rising well beyond control. I mean, they're already, as Peter points out, at target.
And if we move over to Europe to see what's happening there, how will all that is happening in North America be affected by what's happening in Europe? Peter, in terms of the central bank policy by the European Central Bank, what do you see as the current trends and issues facing them?
Well, they've been beating to a different drummer. While we have political challenges now with Trump, their political situation has actually gotten cleaned up with, at least for now, with the elections in the Netherlands and Austria, and obviously recently with France. And it's looking like Merkel's going to lock in her re-election this fall. Then, of course, we have Italy next year, but at least the political worries that were becoming somewhat widespread has been calmed down. We're also seeing better economic activity. And at the same time, there's now growing pressure on Mario Draghi to further taper, because his policy, in my opinion, is completely out of control, and certainly relative to what the European economy is doing now. He's created a massive, epic bond bubble that he is going to pop when he continues to taper, even though he somehow thinks that won't be an issue. So Europe right now is, again, enjoying some calm, but it'll be the European Central Bank and Mario Draghi that completely disrupts that at some point this year, and certainly into next year.
Alasdair, how do you see that playing out? You've recently written about the implications of the Brexit and how there's so many factors of forces bearing on the EU and the European Monetary Union.
Yes, indeed. I mean, Peter's right. The immediate scare stories over politics have receded into the background. But we mustn't forget that there is growing antagonism within Europe, and particularly the Eurozone, about the whole of the EU project. So what's happened is that the problem has been deferred, not resolved. Yes, the EU economy is recovering. There are good signs that it's recovering. Germany has actually been performing quite strongly, but that recovery has spread. I mean, the reality of any economy is that we don't just sit there and sort of moan about it. What happens is that, okay, things are bad and all the rest of it, we get on with our lives, which basically means we go out and we buy our food, we buy our petrol, we buy this, we buy that. Life goes on. And this is really beginning, I think, to shine through in the EU economy. The real problem, I think, that the ECB has is that it has completely mispriced the bond markets. Government debt, I mean, if you look at who would buy Italian debt or Spanish debt or French debt, knowing what the underlying financial position is in those countries at the sort of yields that are available in the market? The prices are way overinflated. The problem is that under Basel II and Basel III, these debts, particularly sovereign debt, is risk-free as far as the regulators are concerned. They're not risk-free. The problem now is that as things begin to normalize in the EU, what's going to happen is that losses are going to appear in the bond markets, and these losses are going to be very, very substantial. That I think is the sort of thing that could be better absorbed in the US banking system. But in the Eurozone banking system, forget it. The banks are horribly weak. They really are. Their balance sheets are complete rubbish. They're dressed up to look good for the regulators. But if you actually dig down, most of those banks are barely solvent, and they cannot afford to take the losses on the bond markets which accompany an economic recovery. I'm afraid that is going to be the big, big problem. Moving on from that slightly, I mean, we've got the Brexit negotiations, but before that gets going, we've got the general election, which is on June the 8th, and there is little doubt, monitoring it from looking at what the opposition parties are doing and all the rest of it, there is little doubt in my mind that Theresa May will get a very strong mandate to negotiate as she sees fit with the EU. The EU actually does want to get a settlement done because it's got other problems. It wants to get a decent settlement. We have also got the prospect here of being able to set up our own trade deals. I mean, there's the potential one of America, though personally, with the fluid situation in America, I don't put that high on the list of priorities. We can very quickly do a trade deal with China, a free trade deal with China, bring in virtually the whole of Asia. There's the old colonies. We are going to be potentially, I mean, there's always the potential for government to screw things up, don't get me wrong, but the potential that Brexit offers the UK is, I think, absolutely enormous. So we then sort of start looking at the effect on currencies. I can see that if interest rates really do start rising in the US, there is going to be a tendency for the euro to be weak, though at the moment it is bolstered by the political concerns are now on the back burner. Sterling, I think, could also recover somewhat against the dollar as people begin to understand that Britain's position in negotiating Brexit actually is pretty good and an agreement is going to be achieved. So I think the only other currency that really we've got to consider in this context, of course, is the Japanese yen. And I think there are moves there. I don't know that there are monetary moves yet, but I certainly see that Japan is beginning to move towards joining the Asia Infrastructure Investment Bank, for example. These are moves which indicate to me that business in Japan is beginning to drive the government in a different direction from where it has been, basically in the pocket of the US. So there's lots and lots of change going on. I think I see one big danger, and that is raising interest rates in the EU. It's going to be very difficult to do it without casualties in the banking sector.
And Peter, do you see that sort of interaction and coordination between central banks of the Federal Reserve, ECB, and Bank of Japan?
I mean, they seem to be going their own way. I mean, if the Fed is going to create policy here, irrespective of what goes on overseas, and it's apparent by the level of easing that's gone on overseas, they're going to do what they want to do. But they're all going to be faced with the same challenge, and that is so dominating and nationalizing the country's assets that you reach a point where you cross a line, and they technically can't, they're not going to run out of things to buy, but you run into restraints where you start to break the market. And the Bank of Japan has certainly broken the JGB market, and the more ETFs they buy, they're going to break the stock market. And so you do reach a natural limit or wall, I think. And that's not even talking about the limits they reach in terms of the inflation that they're creating and, the goals that they've met. I mean, Mario Draghi, the obsession, just when you think about the level of central bank activity for the sole reason that they want 2% inflation. I mean, I call it scorched earth monetary policy, because let's just burn every tree down with all the money we're going to print just because we want 2% inflation. I mean, there is an insanity there. And now they have to live with the consequence that once they actually get close to it, well, how do they reverse themselves? And it's so easy to get in, but they're going to find out it's going to be a nightmare to get out. And just look at the Fed and how much they've dragged their feet on getting out. And here we are in the 9th year of the expansion, and their balance sheet hasn't shrunk $1, and they've raised 3 times.
Yeah. And in terms of the effects overall on gold prices and the long end of the bond market, 10-year, 30-year, looks like it's rallying today. Do you see that as a trend, Peter, like in terms of what we talked about earlier, a transition change?
Well, the interesting thing, and that I want to add to that, is the dollar. I mean, the dollar index, now granted it's a euro-heavy dollar index, has given back the entire Trump trade. It's back to where it was on election day. So for all the excitement about Trump, the dollar just hasn't bought it. Now, granted, it's not just that. It's a variety of things like the ECB, for example, tapering. But I think that's a sign. And now you have the yield curve, the 2s10 spread, is now below where it was on election day. Now, granted, some of that is, I would say half of that is the Fed's raising interest rates and people are worried about the economic implications on a soft economy. But at the same time, we're seeing a drop in long yields because they're worried about U.S. growth and maybe the Trump tax reform not happening. So the only real outlier here is the stock market that is really on a different planet in terms of its perception of the macro environment and the economy and what Trump can do. But maybe today is the first shaking of the tree of that confidence, that considering the valuations and where we've gone and how high we are, this could be just the beginning of something a lot more.
Your thoughts, Alasdair?
Well, this is a very big subject. I think, well, starting with the stock market, I think the reason that the stock market is so overvalued is that nobody is valuing anything in the stock market anymore. Apart from a few hedge fund managers who might actually take the trouble to read the accounts of the companies they invest in, the vast majority of investors nowadays, they just go out and they just buy ETFs. And, it sort of insulates them from reality because you don't have to analyze anything. You buy an ETF. But what happens is that at some stage, of course, the market will turn. And when it turns, guess what's going to happen? You're going to get an awful lot of liquidation. And this is why I think, people like Peter and me are sort of sitting here sort of seeing 300-point dip occasionally thinking, oh, is this it? So far, it hasn't been. These things just go on and on and on. But it is so... you can't even say that the stock market is overvalued. It's just not valued, full stop. Returning down to commodities. I think that something very interesting has been happening with China. I mean, what China has done is she's tried to take a lot of the speculation out of the wealth management products, because what's happened is that these wealth management products have been front-running the Chinese government in its purchases of commodities. I mean, everybody in China knows that the government is stockpiling commodities because of its 13th five-year plan, which basically is to industrialize the whole of Asia and to fill in the bits which she needs to fill in, like, renewing the whole electricity grid and all the rest of it in China. So, basically what China's doing is she's easing down her US treasuries in order to buy commodities. So if you're running a wealth management product in China, then what do? You rush out and buy commodities. So they've been front running, and basically what China has done is they've shaken this out. Now, I think that process is beginning to come to an end, and I think this is the important signal that we're seeing in gold and silver today. Silver has had a very, very bad time. And this year so far, it has actually risen less than gold, which is extremely, it's bizarre, actually. But I think that the reason for that is that there has been quite a lot of carnage from China unwinding or causing the unwinding of these wealth management products, that silver has been particularly badly hit. And I saw one quite convincing story that this is probably the Noble Group in Hong Kong liquidating a position in order to be able to carry, sort of not break a banking covenants and all the rest of it. And of course, the one liquid thing that a company like that has on its balance sheet, of course, is physical silver. So, I think that situation might be coming to an end. It has been masked to a degree by the weakness in the dollar. So if you put together the thought that this liquidation, if you like, of the commodity holdings in the wealth management products, plus the weakness in the dollar, the potential for gold to rise from here, I think is pretty good. So I would see base metals and precious metals beginning to move up from here. I think there's a possibility that this could extend to mid-year, because the bullion banks would like, I think, to see a low price at the half-year stage. But they may not get that opportunity. I think the background to gold and the other precious metals at the moment is actually looking pretty good.
And Peter, do you think that the extent of all of the forces in terms of geopolitical forces that are happening in the world today, what's happening in North Korea, the Middle East, Russia, China, could still propel the U.S. dollar higher, as a safe haven, as well as gold and the long bond?
Well, the dollar's been nothing like a safe haven at all, with at the lowest level since November 8th of the election. So I think people have found other safe havens. Treasuries, short-term treasuries have been a safe haven. Long-end treasuries are a safe haven. And gold is, well, I don't really look at gold as a safe haven. I still look at it as a currency, but dollar has not been the safe haven that it has been in the past. And the whole thing with geopolitics, it's very interesting, because usually geopolitics have a very short impact on markets. North Korea, definitely the rhetoric is very high, and we worry about what could happen, but it just seems like we've been hearing about North Korea forever. And with Russia, Russia invaded Crimea and Ukraine, and the market cared for a couple weeks, and that was it. So I think it still comes down to what affects markets over a longer period of time, and currencies and commodities and fixed income. It's monetary policy and economic growth. And that's what people should really focus on the most, in my opinion.
Yeah. Exactly. And Alasdair?
Well, there are two ways in which you measure the dollar. One is against other currencies, and which is the conventional way of doing it. I would suspect that the dollar will continue weak in the short term, simply because I don't think the rally that we've seen in both the euro and sterling are over yet. I think they've probably got more to go. Measuring the dollar against a basket of commodities, I think you get a rather different situation. I see the dollar being fundamentally weak against the major industrial commodities and raw materials. And I suppose also in a sense against energy as well. Energy is an interesting one because it's just refused to weaken. I mean, I continue to hear so much bad news. I'm not a specialist on oil by any means, but everything I read is about, OPEC can't, or Saudi Arabia and Russia can't keep this deal together. There's too much oil around. It's all being stockpiled everywhere and all the rest of it. Yet the price refuses to go down. Now, that does tell me that there is, at current dollar prices, there is demand for oil there, and it's going to continue. And I would see the purchasing power of the dollar measured in oil tending to go down rather than up. So against commodities, dollar weak. Against other currencies, I think a little bit weak in the short term, but after that, it's going to depend really, I think, on how the political developments pan out.
And Peter, your final thoughts on the geopolitical trends, central bank policy trends, and the financial markets for the next 6 to 12 months?
My first concern is central banks taking away the punch bowl, however gradual, however little. This is the first year in this grand experiment that all five, and I'm including the People's Bank of China, all five central banks in some fashion are either raising rates, ending QE, shrinking the balance sheet, or tightening liquidity. And the only reason why this market is trading north of 20 times trailing earnings and 17 to 18 times forward is because of central bank easy policy. Yeah. The second concern has to be what Trump is going to be able to get passed, even if, assuming he remains in office, or even if he's not, because the obsession with tax reform and regulatory relief, I think has blinded people to other growing risks. And I want tax reform and regulatory for as much as anybody. But any threat to the possibility of that on top of what central banks are doing, those are the two things that people should focus on the most, and less so the geopolitics.
Interesting. And your final thoughts, Alasdair?
Yeah, I think, yes, I broadly go along with, I think, what Peter is saying. What I would like to add, though, is that people have got to understand that we don't have business cycles, we have credit cycles. The reason that we appear to have business cycles is as a result of credit cycles. And actually, if central banks didn't exist, we wouldn't have these cycles at all. But they do exist, and the cycle is quite simple. You have a crisis, and then you have a slump, and then you get a monetary injection, and then it recovers, and it continues, and the recovery gets mature, and then interest rates finally rise a bit, and then suddenly you're into another crisis. So that is broadly the repetitive action of a credit driven cycle. And I think we're getting quite close to that crisis phase, if you like, in the cycle. Quite how it's going to pan out, I'm not too sure. I'm not too sure whether we just all sort of sink under a burden of debt, or whether the US economy and the EU and all the rest of it, they begin to sort of bubble up a bit more. And as Peter suggests, interest rates have to rise, the punch bowl's taken away, QE gets sort of diminished. And that would bring on the crisis. I really think it would. And this time round, this crisis, I think, could even be quite a bit bigger than the great financial crisis of 8 or 9 years ago.
Interesting. A great insight, gentlemen. And how can our listeners learn more about your work, Peter?
They can go to www.bookreport.com, BOOCK report.com, and they can check out free trial and see the things that I write every day.
Great. And Alasdair?
I publish on goldmoney.com. If you go onto the Gold Money website, you've got a choice of personal, business, and wealth. Click on wealth, and all our research is under there.
Let me just add one more thing. You can also check out Bookmark Advisors, as it's an investment management business of mine. BOOKMARK advisors.com.
Great. Thank you very much, gentlemen. We'll do it again another time.
Great. Thanks, guys.
Yeah.
Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.